But our next guest says the volatility isn't a problem for him. It's creating great investment opportunities. Joining us now is Kipp deVeer. He is head of Ares Credit Group, one of the biggest players in the private credit market with $269 billion in assets under management under his purview. Joins me here on set. It's great to have you.
Thanks for having me. Great to be here.
So let's start right there, because we keep hearing that it's private credit's moment. Is it private credit's moment, or is it just that growth that's already been afoot is now accelerating amid higher rates, wider spreads, and more restructuring in banking?
I think it's a little bit of all of that, to be honest. It's a pretty long-running story now where the banks have consistently gotten larger, consolidated, more heavily regulated, and with that has come just a lesser interest in dealing with the companies that we deal with, which tend to be smaller, middle-market companies where we can lend, real estate, infrastructure, private equity, et cetera. So it's just a group of companies left behind for the private markets, which are taking increased share.
So what are the types of groups of companies that are left behind then?
So it's changed a lot. I mean, when we started at Ares 20 years ago, we were financing much smaller companies. We were talking about businesses that had a couple $100 million of revenue and maybe 15, 20 million of EBITDA. Today, we're talking about a much, much broader fairway. So still those smaller deals, but we're playing in companies that have billions of dollars now of enterprise value, $500, $600, $700 million of EBITDA.
So where are the opportunities then in that? Is it real estate? Is it infrastructure? Is it something else?
It's all of that. I mean, the transaction activity and the levels of activity are lower now, just because I think with the change in the rate environment, obviously everybody's trying to figure out what assets are worth. Buyers and sellers are having a harder time transacting, but the easier piece for us has just been the continued retrenchment, frankly, from banks in the middle market. That's on the corporate side. But we're seeing great opportunities in infrastructure and in real estate, too. I think real estate's probably the slowest. It's the hardest to reset because so many investors are long real estate and are trying to figure out what the value of what they own is today. So doing new transactions is harder. The corporate space is actually, I think, more active. But we're all getting questions about when's it going to pick up? Is 24 going to be busier? We think it will be. We think there are better transaction activity levels on the future.
I do want to go back to real estate for a moment, because the comment you just made with investors long real estate, does that mean we keep hearing that there's going to be this bigger, broader shakeout in commercial real estate, especially office? Is it because of how investors are positioned that maybe that's not going to happen, or if it does happen, it's going to be a much slower process?
I think it'll take a fair amount of time. And I'll say this as a not real estate person, and that team doesn't roll up into my world, but spending a lot of time with our real estate group, I think you have to segment real estate and take, kind of prime office out, because that's a very different discussion. Most of our real estate business, luckily, is actually oriented towards industrial and multifamily and non-office assets. So you really have to go kind of vertical by vertical to think about it. But yeah, I do think it's going to take a while to materialize.
Going back to the banks for a minute, because you did strike this $3.5 billion deal to take a loan portfolio off of PacWest's books during the summer. Do you compete with the banks? Do you partner with the banks? I guess, what does this landscape look like as you do have regional banks that have had a really tough year, are existing in a higher for longer rate environment, and are rethinking their investment portfolios?
Look, I mean, I think we do both, depending on what portion of the business you're talking about. In our lending businesses, our corporate lending businesses, the banks are our largest lenders, right? So when we go out and we raise equity for our funds and we put modest leverage against that equity, we're getting that leverage from banks. So inherently, we're partnering with them in that simple way. We're also partnering with them on deals, right? But the PacWest situation was a little bit different. They obviously ran into some liquidity issues at their bank. That was a pure sale of very high-performing, high-quality assets to us at a very good price, I think, to them. So it's not like we did some sort of discounted purchase there. We paid a full price for a good set of assets, but they just needed liquidity at the time. So we were opportunistic providing that liquidity.
Okay, quick last question for you, and that is, where do we go from here with this? If you do have a higher for longer rate environment, you mentioned deal activity potentially picking up next year. What is your outlook on the ability to service more companies, issue more loans, if that continues?
Well, so at Ares, I mean, we feel great about our ability to transact. We have abundant liquidity, and we disclose every quarter kind of what our dry powder is, and it's very substantial in all of our businesses, whether it's credit, private equity, real estate, et cetera. So we just need the buyers and the sellers of assets to start to find more agreement on what a transaction price is that works for both. We feel great about activity levels picking up into next year.